My guest today says a major bear market is not only underway, but it's accelerating. And according to his firm's analysis, investors are not prepared for what's coming next. Hey everyone, I'm Jeremy Szafron. Welcome back to Kitco News. Now we got lots to get into today because despite a cooler than expected inflation report from March, long-term Treasury yields are still climbing. That's a sign that deeper stress may be building beneath the surface. And with President Trump's latest tariff escalation on China pushing effective duties to 145%, investors are asking, will this force the Fed's hand? And could we be approaching another critical intervention moment? Joining me now is Stephen Hochberg. Sorry, Stephen. He's a chief market analyst at Elliott Wave International. Stephen and his team study market patterns through the lens of investor psychology. And right now, the signals say that they're pointing to a historical unwind. Welcome to the show, Stephen. Great to see you.
Great. Thanks for having me. Really looking forward to it.
Yeah, me too. Of course, we were talking here off camera. It's never a dull day here in the headlines. And speaking of them, the headlines are dominating. I mean, Trump's new tariffs now push effective duties on Chinese imports to 145%. And as I mentioned off the top, the markets are reacting fast here. The Dow's down over 1,000 points and volatility is surging. Now, through your Elliott Wave lens, does this tariff shock mark a new phase in the bear territory market that you've been forecasting, or is it simply accelerating what was already unfolding?
Well, the way we look at things, our model that we use, which is the Elliott Wave model, starts with psychology. And the trends in the market are determined by the mood of investors in the aggregate. So when the mood turns negative and you get a stock market high and stocks start to go down, well, you have negative forces going out through the economy. And things happen like strife, like tariffs, like secessions, wars between countries in a very broader sense. So it's not, from our view, we have a little bit different take on it. It's not that the tariffs are causing the market to go down. It's that the negative mood, which is manifesting in declining stock prices, is also manifesting in strife, which is tariffs between trading partners. It's all feeding into itself. And I think this is compatible with what we're seeing in the market. I still think it's got more to go on the downside.
Okay, well, that's what we got to get into. But before we do, let's talk about the immediate reaction in the market that we've seen today. I mentioned the Dow dropped over 1,000 points. Gold spiked towards $3,200 an ounce on the spot side. And of course, this comes after a day after this historic rally following President Donald Trump's announcement of a 90-day reprieve on some of his reciprocal tariffs when he dropped his country-specific tariffs down to a universal 10%, except for China. Now, there are many analysts debating Trump's strategy here and some questioning whether he has a strategy at all. But do you think this was the plan all along, or is he salvaging a plan that went wrong?
Well, I think he's just part and parcel of the mood right now. And as the mood turns negative, people view actions of the president a little bit more negatively. For example, when we're in a bull market and stock prices are rising, whatever a president does, he tends to get credit for it, and people look favorably on president and the government. And when prices peak out and start to turn down, whatever the president does, people tend to look a little bit more negatively at it. And so it's not one or the other. I think we're in a transition period right now. So I think the negative mood is feeding into this perception of Trump as a chaotic president, or whatever you want to call it. And as the market goes down a little bit further, I think things are going to get a little bit more negative in terms of what people view the government as.
Right. Yeah, Stephen, we've been talking about evaluations on the program on the equity side in terms of the S&P, some of the Mag 7 for a very long time. Stock evaluations seem to have been, quite high here. You were mentioning that you have a chart. Talk to us a little bit about where the stock market is before this breath was being taken.
Yeah, I want to take a step back and pull up this chart of the Dow in terms of real money, which is gold. And this is a chart of Dow gold going back from 1980 to the present. Now, the peak value, what I want to talk about is there's some interesting dynamics here. Number one, stock prices are still elevated. They're not that far from their old all-time highs, but stock values are down considerably, and stock valuations are at near record highs or at record highs. And the question is, how can you get all three things at the same time? And I think this chart really helps to explain it. So this is the Dow in terms of real money, which historically has been gold. And in July 1999, the Dow could buy about 41 ounces of gold. And that was its peak value relative to historical real money. And then, of course, we had this bear market, a crash into 2011, where the Dow can only purchase a little bit more than 6 ounces of gold. And then we had a rally back into 2011, where the Dow could purchase about 20 ounces of gold or so. And if you notice, since then, it's been leaking lower. And so when I say that the stock values are down, that's what I'm talking about in this chart right here in terms of real money. The Dow, in terms of nominal prices, is elevated. But that's just because of monetary inflation. But you can see right here that the purchasing power has been deteriorating ever since. And since we published this chart in February, it's gone down even a little bit more. So I think in terms of value of real money, the Dow is down about 71%. But yet, in terms of historical valuations, and I'm going to pull up another chart here to show what I'm talking about here. In terms of historical valuations, in terms of, say, price to sales ratios, which you see on the right side of your screen here, we're 40% higher than we were at the peak in the dot-com mania. Wow. And on the left side of the screen, this is what's commonly called the Buffett indicator, used by Warren Buffett, which is looking at the market relative to annual GDP. And you can see we're 2 times what, in terms of GDP, what the market value is. So we're at record levels here, yet the valuations are, or values in themselves are down. So I think this kind of gives us an idea of what's happening underneath the surface. We've had a monetary inflation. The purchasing power of the dollar has gone down, which has given you the illusion that everything else is going up in value, when in essence, it's just that, an illusion. So this is kind of the key that we're looking at right now.
Interesting. Okay. I want to talk to you a little bit about what's been transpiring. We've been talking about cracks, and there's something very interesting happening with the U.S. Treasury market as well. I mean, I want to give a brief to our viewers for those that don't know. I mean, U.S. Treasuries are government-issued debt. When you buy one, you're essentially lending money to the U.S. government. And in exchange, you get paid interest over time, and they're considered one of the safest investments in the world because they're backed by the full faith and credit of the U.S. Now, it's an important thing to note that the yields move inversely to prices. When investors are confident and move into riskier assets like stocks and treasuries, prices fall and yields go up. But when the fear strikes and investors start to seek safety, they typically buy treasuries, pushing prices up and the yields down. But what we're seeing now are rising yields despite all of this fear. And in the past, we'd likely see investors rush into treasuries. Are we witnessing, a breakdown in the traditional flight to safety narrative here? Talk to us about this trend. What's happening here, Stephen?
Yeah, I think there's some sort of dislocation going on underneath the surface of the bond market, because you rarely, if ever, have bond prices drop 10 points in a matter of several days. So it seems to me there's some sort of forced liquidation going on here. You can speculate maybe a hedge fund's in trouble or whatever. Mm-hmm. But what's interesting from our perspective in the bond market are credit spreads, because I think credit spreads really tell a story of what we think is going to be happening and gives us a window into the future. And here's another chart that I want to just pull up to point out. This is the junk bond credit spread. It's the junk bond yields relative to comparably dated U.S. Treasuries. And if you notice here, they've really spiked higher. They've broken a 3-year declining trend line, and they've gone from about 2.56% spread, almost doubling, up 70% in a matter of a very short period of time. And this is something that we talk about often in our publications at Elliott Wave International, because credit spreads, when they start widening like they are here, tend to precede broader financial trouble. And one other chart that we published way back in January, several months ago, that kind of foreshadowed what was happening here. Whoops, let me go back one more chart. What we did in our newsletter, the Elliott Wave Financial Forecast, is we discerned a pretty regular 3.4-year cycle in credit spreads going back several years, as you can see on this chart. So even before spreads broke out to the upside, we had a pretty good idea that they were going to make that move up based on this cycle, because the cycle was bottoming and turning up. It gave us kind of a window into the future to suggest that there could be some financial problems coming down the road. So this was January, and here we are now in April,
Interesting.
and we're starting to see those problems come to forefront.
Yeah, I was going to say, I mean, is this the canary in the coal mine for a broader credit event? I mean, is this the first clear signal that you're kind of seeing that this is spilling into the broader markets?
Yeah, I think you put that excellently. It is a canary in a coal mine. And when you get credit spreads widening like this, breaking out, and with the potential to go a lot higher as the cycle keeps going up, I think it proceeds and is giving you a window into the future of broader troubles that we're going to have within the credit markets. And that usually spills over into the stock markets, which is another reason that I think, besides the Elliott Wave model we use, that we're in a bear market.
Yeah, there's also this increasing concern about leveraging the Treasury market. We were talking a little bit about it there with the hedge funds, but some are suggesting China may be offloading Treasuries in retaliation of these tariffs. We know that in 2024 alone, the value of U.S. sovereign debt held by Chinese investors fell by $57 billion, their lowest level since 2009, and that's according to data published by the U.S. Treasury about a month ago. How much do you think this accelerated in 2025?
Well, we'll see. It's certainly possible. We don't know the figures as of yet, but in an environment of a increasing negative mood where people are selling stocks, credit spreads are widening, it wouldn't be surprising to see foreign governments also caught up in this negative mood and thereby expressing themselves in various degrees. One of them might be selling U.S. Treasuries.
Yeah, I mean, there's those fears building that you kind of mentioned there around hedge funds that have been taking on massive leverage to exploit tiny gaps prices in the U.S. Treasuries and in the futures. As these geopolitical tensions rise, could we see large institutions piling liquidity and triggering margin calls and hedge funds unable to meet the collateral demands? I mean, would dumping Treasuries en masse turning this into, quite an event?
Yeah, I mean, that's certainly possible. In terms of margin debt, I mean, we have record levels of margin debt. So, at some point, if the market keeps going down, you're going to get a call from Mr. Margin Clerk, and he's going to say, "Sir, we need some capital here." This is all part and parcel, I think, of what happens during a bear market. Things happen,
Right.
that you don't expect, but they're all corollary to the model that we use, which shows an increasing negative mood out there.
Yeah, I have to ask you, I mean, it's hypothetical, but if there is a risk of that happening, what kind of a response could we see from the Federal Reserve? I mean, in 2020, the Fed stepped in to stabilize Treasury markets. Do you believe that the Fed is about to repeat that intervention? And what could be the consequences this time? I mean, what would that intervention look like?
Well, at some point, it's too big to bail. I mean, we're $36 trillion in debt, $1 trillion every year just to service the debt. Historically, the Fed's response has always been to try to bail out the economy, to try to shore things up. Interestingly, though, we've kind of looked at this historically, and usually the Fed comes in closer to a low than it does at a high. So what happens is the market starts tumbling, spreads go wild, yields go wild. And then the Fed finally steps in, and it looks like that they're controlling the market, but they're really not. Usually a trend is near exhaustion by the time the Fed gets involved. But look, yeah, I mean, historically the Fed has acted, but at some point the market is just too big for them to be able to control anything. For example, 2007, 2009, during the Great Credit Crisis, the Fed tried to bail out, Lehman Brothers and so forth, but look, the stock market still went down 58%. So the question is, were they successful? And I would argue, and I think a lot of people's portfolios at the time would argue now that they weren't successful.
Yeah. Well, I can guarantee there's a lot of conversations going on right now looking at the data behind closed doors. And while we're on the Fed, I mean, inflation came in cooler than expected last month. The CPI, or the Consumer Price Index, rose 2.4% year over year through March. That's below the 2.6 economists had forecasted. Meanwhile, on the core basis, excluding volatile food and energy, inflation slowed to 2.8%, also a deceleration from February. What's your inflation outlook given all this accelerating trade war narrative with China?
Well, you can get short-term bouts of inflation, but I think the ultimate outcome here is really debt deflation, because we have so much outstanding debt in society right now. We can't service it all. It's just an untenable situation. And when you get bankruptcies and bankruptcies are on the rise, and you get debt restructurings in a fiat-based credit system like we have right now, that's very deflationary. I know it's not a popular view right now, but to us, that's the end game of where we're going here. As debt gets paid down or reworked or bankruptcies or people just stop taking on debt, that's very deflationary environment. We're actually seeing a decline in the commodity prices across the board right now, which is kind of giving us a hint, I think, of what's going on in the future there. But I think people have to be very careful and be very safe in this environment.
Okay, well, let's talk about the commodity prices there coming down, because what could this all mean, what we've been discussing for gold? I mean, it's another safe haven asset. In the long term, if this continues, I mean, will it have a big impact on the price?
Well, outside events like this don't really impact the price of gold in the way we look at things, because our model is very internally based on psychology. Now, gold's had a great run up. What's really interesting is, and I showed that chart initially of the Dow gold ratio, which peaked in July of 1999. Well, from July of 1999 to today, the Dow Jones Industrial average is up more than 5 times, but gold is up more than 10 times. In other words, gold's up over 1,000%. Dow's up maybe 400 to 500% over that entire period from July 1999 to the present. So if you just bought gold back in July of 1999, you would have been outperforming not only the Dow, but also the S&P and also the NASDAQ over this period. Not many people realize the performance that gold's had. Now, I think the problem that gold has right now is silver. Because while gold peaked in 1980 at about $8.50 an ounce, it had another big peak in 2011 that was more than double the peak in 1980, and then this latest high is another 60% higher than it was in 2011. But silver, it peaked at $50 an ounce in 1980. It matched that basically in 2011, and it's down 38% from its 2011 high. So you've got this long-term divergence, and I think that's a problem for gold unless silver just takes off and goes vertical from here. And we don't see that happening right now. I think what silver is forecasting is a softening in the economy going forward. And right now you just have this big bearish divergence between the two. Now, can gold hold up? Sure. I think on a relative basis, gold's going to do much better than the stock market is. But is it going to go blasting through 5, 6, 7,000? Not unless silver, I think, can get his act together and join in the parade there.
Interesting. It certainly hasn't been. I mean, we're sitting here watching it between 30, 31 today. Does it eventually catch up in this cycle, Stephen? You're saying not really.
Well, I think as the economy continues to weaken, which we think it will, I mean, credit spreads are going up. You had an inverted yield curve, which is now uninverted, and that's got an unblemished record of forecasting economic recessions. I think we're heading that direction. And if that's the case, then silver, which is not only a precious metal, but also an industrial metal, is giving you a signal that there's going to be a lot of softness in the economy. So I'm not sure silver can really take off from the upside. But look, we could be wrong. We'll have to watch it. We're looking at the Elliott Wave models, and if things change, we'll certainly be communicating that to our readers.
Yeah, I mean, you wrote that all major U.S. stock indexes appear aligned in a major bear market here. Talk to me a little bit about the Russell 2000. I mean, you talk about it. It's often a leading economic indicator, and you connect that to a looming economic contraction. Walk us through the implications of a small cap underperformance here.
Yeah, I mean, it really is a key sector. And the reason being is because it's the most economically sensitive sector. A lot of these companies don't have the big access to capital that these large corporations have. So they're very sensitive to what's happening locally. And that sector peaked out in November of last year. In fact, if you look at the market, a lot of things have peaked out in November of last year. You had the Dow Transports, the Dow Utilities, the Russell 2000, and then in December you had the Dow peak out. You had Bitcoin peak out in January of this year, and then finally the S&P 500 and the NASDAQ. So I think the Russell 2000 has been a leading sector on the downside, and that's something that we're watching very closely because if that continues to go down, and it looks like based on the Elliott Wave patterns that we see, it will. That does not portend well for the other sectors of the market right now.
Yeah, interesting. We got to talk about the Mag 7 too. I mean, the tech stocks, it almost had kind of a hypnotic hold on investor sentiment. They're selling off dramatically here relative to the rest of the S&P 500. You call this technology's breakdown in leadership. Does this signal the end of a growth stock era, or is this just a pause here, as we talked about?
Well, I think it priced in years and years of growth in such a very short period of time. It was like the internet was at the dot-com mania peak. The internet was going to be around and change the economy, but we had priced in years and years of earnings in such a short period of time. Same thing happened back in 1929 when RCA came out. I mean, television was the future, but RCA shot up in price and priced in probably 10 to 15 years of future earnings in a very short period of time. So when the stock market crash came in 29, it took RCA decades to get back to even again. And I think the same thing's happening with technology now. There's no doubt that AI is the future, but the future is not a straight line. And I think there's a big valley that we have to go to in terms of these stocks and their valuations before we get to that realization down the road.
Yeah, interesting. I mean, you also described the current environment as one of crushing thirst for cash. I mean, is the next phase of this bear market going to be a liquidity crisis here?
Well, absolutely. In fact, in our view, cash is king. Cash is outperforming stocks right at the moment. As the market goes down, the value of cash gets much more valuable. But not only that, but cash is safety right now. And I think safety is paramount for investors. They really have to think about their portfolio, think about their own situation, and become and look to safety. Right now, short-term Treasury bills are still, I think the 3 or 6 month bill is still around 4% compounding. So it's a pretty good rate of return if the stock market's going down and giving you losses. At least you're safe. You don't have to worry about the stocks. You can actually have time to think and evaluate what's going on. And so I think just being safe right now is the way to go for investors.
Yeah, preach it. Because, despite all this, Stephen, I mean, retail investors are still piling into stocks. They had record inflows, aggressive use of leverage. You suggest that there's a, psychological lag here, that sentiment hasn't caught up to the new trend. Just talk to us a little bit about how dangerous is this disconnect?
Well, yeah, I mean, because if you're positioned long and the market's going down, obviously it's very dangerous for your portfolio. But we look at a lot of things in terms of sentiment, because sentiment really is the true driver of the market. And a lot of the sentiment surveys short term got very bearish and negative. But what people are actually doing with their money is just the opposite. They're buying stocks and they're holding on and they're not selling. So this tension, I think, has to be relieved at some point. And the more the stocks go down, the more the tension grows. Usually what happens is investors finally throw in the towel, start liquidating their portfolios, and that's when you're coming into a pretty good low at that point. People kind of just give up the ghost, throw the towel and say, I don't want it anymore. That usually creates the low. That's not what's happening here. People, like you just said, are pouring money in the market, and that's usually not historically how you make a significant bottom in stocks.
Yeah. I mean, what phase are we in right now? Is it denial? Is it bargaining? Is it something else? Because you point to historic analogs like 1929 and the early 2000s, moments where these euphoric investors ignored these warnings.
Yeah, I think that's exactly right. And I think the denial stage is where we're at right now, based on the patterns that we see unfolding in the market. As we go down further and take out the recent lows, I think you start seeing that denial move into a little bit more recognition, and then finally into panic. And panic is where you just get that capitulation and people throwing the towel, and you get a low. And it doesn't look like we're there yet based on the indicators we're looking at and based on the Elliott Wave pattern.
Okay. Yeah. Well said. Okay. If we're not there, are we going to see a recession? That R word is back. I mean, Larry Fink said that we are already in one, according to the CEOs he speaks with over in New York. Are we in a recession this year? When will it hit, and how bad do things happen?
Well, we're in the countdown one, that's for sure. It actually may be underway. Like I said, one of the great indicators of when a recession is going to occur is the yield curve. And we had yields on 2-year notes higher than 10-year notes. That was inverted for a record period of time. That uninverted just recently. So we're now in a steepening yield curve, and that's preceded every single recession over the last 50 years. So we're in a countdown to recession. I think recession, I'm not even sure I would use the word. I think it's going to be something very, very deep. People could say depression, they could say recession, but what we're going to have is an economic contraction. It's going to be a contraction that's deep enough that's going to, I think, hurt people. And so, again, it's just feeding into this notion of just trying to be safe and smart with your investments at this point in the cycle.
I got to ask you about the U.S. dollar, too. It's been fascinating to watch. And we just saw this interesting report from Reuters saying that Chinese central bank is reportedly asking major state banks to limit U.S. dollar purchases and support the yuan amid pressures from U.S. tariffs. How do you interpret this intervention? What does it tell you about China's thinking here? I mean, will it have an impact on the dollar?
No, I think the dollar moves independent of outside activity like that. But what's interesting in the dollar is way back in 2008, no one wanted it. It was a signal that we're actually bottoming in the dollar. In fact, there was a news story that we saw where Gisele Bundchen, the supermodel, wanted to be paid in anything but U.S. dollars for her modeling gigs that she was doing. This was in late 2007. So we kind of took that as a sentiment signal that we're pretty close to a low when a supermodel was recognizing the dollar was going down. Well, the dollar had a huge rally from 2008 all the way up to 2022. It traced out what we call an impulse wave in terms of our model that we use. And ever since then, we've been forecasting a decline in the U.S. dollar. It's followed our forecast actually very well. I don't think the low is in yet. We're probably going to go well below par, maybe in the mid 90s on the U.S. dollar index. And the patterns that we follow are kind of guiding us into this direction. So it looks like we still have some more to go in the weakness in the U.S. dollar.
Okay, so I wonder the timing here, because your forecast isn't just bearish on stocks. I mean, you're warning of a full-blown economic contraction, as you just mentioned, and consumer sentiment is collapsing with bankruptcies up, delinquencies rising. What's the trigger that takes us from slowdown to crisis?
It's psychology. It's all of us interacting, and we go from optimism to pessimism in a very patterned manner, and we go from pessimism to optimism in a very patterned manner. This is what R.N. Elliott discovered when he put together this model that we use called the Elliott Wave principle. And so there's not outside triggers. It's more endogenously regulated, meaning that all the psychology that kind of moves the market is internally generated from people interacting. So I think we're in this pattern right now that's going to take us lower over time. We don't know exactly when the low is going to, but we can kind of, when we get there or get closer, we'll be able to see it through all these indicators that we follow. We follow over 100 indicators here, and when they get all extreme in one direction, then we know where they're coming into a pretty good low, and we're not there yet.
Yeah, I mean, your report refers to how economists remain really optimistic on GDP growth, too, even though we're starting to see that impact now with the tariffs. We're starting to hear more people talk about what that effect means for Q2 earnings, jobless claims. What do you think they're missing here on the economist side?
Well, you know what? The greatest leading indicator is the stock market. And I think they're looking at all these lagging indicators. For example, when we report inflation or earnings, it's telling us what happened last month or last quarter, but that doesn't necessarily mean that trend is going to continue into the future. But I think when you look at the stock market, it is the best leading indicator of what is going to happen. And I think that's what economists are missing. They're not looking at true leading indicators. And as the market goes down, people get more pessimistic. They start pulling back in their endeavors. They might even start selling stocks, and that leads us into that economic contraction that we see coming for the economy.
Stephen Hochberg, Chief Market Analyst at Elliott Wave International. What a powerful, interesting discussion. Your analysis brings some clarity at a time when investors are struggling to understand what's really driving this volatility. Thanks for being here, Stephen.
Thanks for having me. I appreciate it.
Appreciate it. Thank you for joining us. I'm Jeremy Szafron. For all of us here at Kitco News, thank you for watching. Be sure to hit the subscribe button, like the video, and we'll be here all week long. Stay tuned.